Inflation is running well above target, and growth is well above potential.
And there are signs now of more persistent price pressures.
It is very unlikely that we will raise interest rates in the year 2022.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Central bank divergence. While the Fed and the BOE see inflation as the main threat, Lagarde's ECB sticks to its pandemic-era monetary policy. Also, turning up the heat, the U.S. pushes the EU allies for broader sanctions against Russia as a bloc fails to agree on a solution to its gas crisis. And the lira tumbles to a record low. The Turkish central bank cuts its key rate and says it's ending its easing cycle. So a lot of focus, of course, on the markets. We did see a sell-off that started off with technology stocks in the U.S. We're still seeing quite a lot of pressure here in Europe. Banks also on the way down some 1.4% overall. If you look at the European Stock 600, down 0.4%. Now, the picture is they're looking at what we heard from central banks yesterday on inflation and why they're starting to normalize. Yesterday, there was a bit of an upside lift. Today, I guess they're wondering about divergence. There could also be a bit of profit taking just because it is the last working Friday before the holidays. And you can see the S&P 500 futures down some 0.1%. Look, the U.S. dollar Turkish lira is actually looking at some crazy moves. I know it's not a technical term crazy, but if you would have told me just 18 months ago that we would have touched 16 per dollar, a lot of people wouldn't have believed you. Just moments ago or days ago, we touched 14, and that was a big psychological level. Now let's make a difference with what we're seeing in the FTSE, but the FTSE MIB and the DAX. You can see the FTSE is actually holding on to some gains. It was lower in the last 4 to 5 days compared to some of the other ones. The biggest loser in today's trading session, the FTSE MIB, dragged lower by a lot of the banking stocks, down 0.7%. Now, let's try to digest some of those central bank decisions in what has been a busy week for policymakers. We're joined by William de Wilder, a chief economist at BNP Paribas, and Bloomberg's Christine Aquino. Thank you both for joining us. So, William, let me kick off with you. What was your main takeaway from all of the policy divergence that we heard from the Bank of England, the ECB, and of course the Fed? They have the same concerns. Of course, economies are a bit different, but actually the way they think about it is wildly different from one to the next.
Indeed, same concerns. I would say the same journey as well. The direction is the same. The speed is very different. And I would say what is striking is that you have a flexibility in terms of the approach that you observe in the US and in the UK as well. Whereas with respect to the ECB, the policy reaction function is very strict. There's very strict rules in a way self-imposed on what is required to contemplate a policy rate hike, and we are not there based on the projections. So in a way, the ECB is very consistent with its approach.
Let me also show you a chart actually that our Valerie put together for us, and it really shows, Christine, some of the divergence that we're seeing in terms of central bank policy. You look at the BOE, you look at the Fed, and of course the ECB, and I would add to that maybe the BOJ. It's going to be very, very different on how the currencies actually perform.
Absolutely, Francine. And I think that is going to be one big wild card heading into 2022 is how much of this is actually priced into markets at this point. You could argue because there's so much priced into the Bank of England rate expectations front, for example, there's probably some room for sterling to reprice that, for instance, if things don't go as well as expected when it comes to growth, when it comes to the Omicron situation and other potential variables for the UK economy. And then on the flip side, with not much priced in for the ECB, but at the same time, the ECB flagging upside risks to inflation, you have to wonder, is there more room for the euro to price in those expectations, especially if we get more evidence that inflation isn't quite as transitory as we would have been led to believe in Europe?
William, do you agree with that? And actually, are we underestimating the impact that Omicron or another variant could have on economy closures?
Well, first of all, I fully agree with what Christine has said. I think what's important to keep in mind is that the ECB will not hesitate to change its tone if it sees inflation higher for longer. Let's not forget that yesterday in the staff projections, there was a pretty significant upward revision for the inflation part for 2023, and then with the new forecast for 24. In the same way, we should not be surprised if it turns out, because of infections, Omicron and what have you, that the tone from the Fed and the BOE would evolve as well. So I think there is indeed a clear potential that we would be surprised, and that would then be a factor supportive for euro. I think in the very near term, the key issue that we are facing is what's going to happen with the infections. As we see, there are travel restrictions that are being introduced, and it gives us a very uncomfortable feeling for the near-term economic momentum, in particular in certain services sector. And that means that the first quarter of next year could actually be quite a bit more subdued. A major question that is related to that, of course, is this going to imply that you will have longer supply disruption and hence even more inflationary pressures being put? In that respect, the PMI flash data yesterday were bringing some comfort, a tiny bit, that some price pressures seem to be easing.
Where do you see, Christine, the biggest interest coming actually from the market? And I know we'll get onto some of the quirkier moves, but there seems to be quite a lot of maybe European bonds that we need to look at as well.
Yeah, absolutely, Francine, because I think, we saw a lot of investors trying to navigate the message from the ECB yesterday, especially with regards to the PEP program and what shape the APP is going to take once the PEP program ends, right? And initially, we saw, for instance, Greek bonds rallying quite a bit heading into the rate decision. I think there was some speculation that perhaps the APP program was going to be a little bit friendlier to Greek bonds once PEP ends. I think that rally faded a little bit once we got more specifics of the program, but I think it's going to be interesting to see how that all unfolds and how, the riskier parts of the European bond market will navigate this. Italian bond spreads also in the mix. That's, of course, a favorite gauge of risk in Europe, and I think the consensus there is for a little bit wider BTP bond spread heading into 2022 as well, as we do get a little bit of normalization from the ECB, even though it's not as fast as we would see, for instance, from the Fed or BOE.
William, what does a policy mistake actually look like from the ECB next year? It seems that they want to, message and manage the markets very carefully so that we don't have a kind of taper tantrum. Is there something that makes you worry about the path forward?
Well, the concern that I have for the euro area, and it would influence monetary policy, of course, is that you would have a tightening of financial conditions imported from the US. That's my real concern. Up until now, tapering in the US, no impact on markets whatsoever. Congratulations to the Fed. Hawkish tone, no market impact. Again, congratulations. Eventually, as we get into the second half of next year, we will be underway in a policy tightening cycle, market focusing on how many rate hikes in 2023. So that means more volatility on the S&P. Dollar should have strengthened normally. Corporate bond spreads should be widening. And part of that reduction in global risk appetite, which is manifested in what I've just described, would then actually spill over to the euro area. That means that, it could mean that for the ECB, it could actually be forced to hold off a little bit longer before envisaging a rate hike. Importantly, however, in the message yesterday is that the increase of the APP is only temporary. So I think what they're really already preparing is that later next year they will start with an announcement of tapering the APP.
Yeah. All right, thank you both. William de Wilder there, Chief Economist at BNP Paribas, stays with us. Christine Aquino, thank you so much for all of the market insights. Now, we're also just getting some breaking news out of IFO. This is for the December German business confidence. It's quite telling because I think it just catches right at the beginning of Omicron, or maybe it misses it by a couple of days. I need to look at exactly of what we were looking at in December, but it's a little bit below expectations. So it does take into account the formation of the new government. So we have plenty to talk about when it comes to Germany. 94.7 instead of 95.3 we were expecting. Now, later this hour, we speak to the IFO president, Clemens Fuest. You can send in your questions on IB Plus TV Go. This is Bloomberg.
economy is so much stronger now, so much closer to full employment. Inflation is running well above target.
Inflation is expected to remain elevated in the near term, but should ease in the course of next year.
There are signs now of more persistent price pressures, and that is a concern to us.
It is very unlikely that we will raise interest rates in the year 2022.
We are phasing out our purchases more rapidly because with elevated inflation pressures and a rapidly strengthening labor market, the economy no longer needs increasing amounts of policy support.
Some of the highlights there from this week's central bank meetings. Now let's get back to William de Wilder. He's chief economist at BNP Paribas. William, we talked a little bit about some of the policy divergence that we're seeing across the world. We mentioned Omicron and some of the concerns, of course, as we go into the winter season. But, your main takeaway for 2022, is there something that you think could go wrong that would actually really take us by surprise?
Well, the obvious candidate is that inflation lasting longer. And really that is based on the idea that you would have second round effects. It is striking to see the dynamics of wage increases in the US, employment cost index, wage tracker. But even anecdotally in Europe, you also see that the pressure is on the rise. That, by the way, is actually good news because, after all, what we want in Europe, that we would reach the inflation target. So that would be one candidate. The second candidate is that financial markets in the fall of next year would become obsessed about what is the impact of cumulative tightening by the Fed, including what is expected for 23. How is the economy going to digest that, and that you would have a kind of growth scare kicking in?
So, William, a growth scare that central banks could mishandle, is there worry actually of policy adjustment right now?
Yeah. Well, as you know, the ambition of every single central banker in a policy tightening cycle is to achieve a soft landing. As Greenspan in the old days told us, soft landings are very hard to achieve. So I would say that if we would speak in 12 months' time, that is going to be the key question looking at 2023, will the US soft land? Now, in a way, it looks very premature to even talk about that, given how strong all the data look like and the fundamentals are really well-oriented. But I still think that with the tightening of the financial conditions and with rate hikes of the Fed, that is going to be an overriding concern. I think for that reason, what the Fed will do, I would expect, is that they will tread very cautiously. And the reason is that a policy mistake, of course. The cost of a policy mistake is very high if you have very limited policy leeway and to cut and ease afterwards. So that's why they do not want to make a mistake.
William, one of the other things that we're trying to figure out is, of course, some of these supply chain issues, and I don't know whether they stem for also transition to a newer economy or it's just because of Omicron. But how much will they ease? We're seeing supply shortages of a lot of semiconductors. There's also labor shortage because of a mismatch. Does this continue well into 2023?
Well, labor shortages probably will last for quite some time. When there is a cyclical dimension, there is also a health risk dimension in the sense that people being exposed cannot go out for work, have to take care of their children and whatever. I think another important point that you see is that there have been quite massive changes in how we could call it, preferences of people that have said, well, I can work in another sector and I do not want to work long and very odd hours. So some of these sectors are suffering from that. You see, again, anecdotally, wage negotiations in France, for instance, in the hotel and restaurant sector that are really pointing towards pretty significant increases. So that's on labor. I think on the supply chains, the problem is that in certain sectors, production is very inelastic, supply is inelastic. Think of semis. It will take 3 years before a new plant is up and available for running. And so that's going to be an issue as well.
William, thank you so much for joining us. William de Wilder, there, chief economist at BNP Paribas. Happy holidays. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. Boris Johnson has suffered a political upset, losing a key parliamentary by-election. The Liberal Democrats took the previously safe Conservative seat of North Shropshire with a majority of nearly 6,000 in a special election after a lobbying scandal. At the previous election, the Prime Minister's party won the seat in the West Midlands with more than 62% of the votes. Now, Goldman Sachs says it cannot rule out oil at $100 a barrel in 2023. That is because supply additions are expected to be slow to keep up with demand. Goldman's base forecast is for Brent to stay around $85 over the next 2 years. The bank says consumption of gasoline, diesel and plastics could reach new highs in 2022. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, coming up, Germany's IFO Business Climate Index for December falls a touch. We speak to the IFO President, Clemens Fuest. If you have any questions for him, IB Plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Germany's IFO Business Climate Index for December has fallen as companies have lost confidence in the near-term economic outlook after resurgent coronavirus infections forced new restrictions and raised uncertainty. Well, joining us now is IFO Institute President Clemens Fuest. Mr. Fuest, I'm actually surprised that it didn't fall by, as much as it could have because we were just at the beginning of the coronavirus. Is the threat of coronavirus and potential lockdowns being underestimated, or do you think the economy can look through it?
Well, I think that really depends on how this wave plays out. The difficulty is that we don't really know how bad Omicron will be and how severe the infection will be. It will spread quickly. And I think the worry is that there will be lockdowns also for vaccinated people. Currently, we have restrictions for unvaccinated people mostly. But the worry is clearly that this will need to be extended because hospitals are overcrowded. And I think that's the risk for the economy. Manufacturing will get through it better, but for services, for retail, this is a big problem.
Mr. Fuest, talk to me a little bit about what you're expecting for 2022. How much easier will the supply chain constraints be? Are you expecting it to be about the same, or will it get significantly better?
Well, what companies are telling us at the moment is that they do expect these things to improve in the coming months. In this survey, the share of companies telling us they have supply problems has risen even above 80%, which is bad. But at the same time, companies are telling us they do expect this to improve. So we would improve problems to remain in the first quarter, but then in the second and third quarter, we expect things to improve a lot. In manufacturing, order books are full. So there is a potential for a strong recovery, probably starting in the second quarter.
What does it give you in terms of, labor shortages? This is one of the big things that we've been talking about. Are you expecting that to ease at all? And what are you expecting from the new government?
Well, labor shortages are not as bad in Germany as in the US, for instance, but they are there. Of course, they are holding back some investments and some production, but I don't think they are holding back the recovery at the moment because there is quite a lot of short-time work. The new government will try to address this more with medium-term measures like facilitating immigration, improving labor supply incentives. There are some issues in our tax and transfer system that prevent people from working. For instance, the taxation of couples reduces labor supply incentives mostly for second earners, which are women in the majority. So the government is aware of these issues and will do something about it.
What does that mean for inflationary pressures? And is the biggest, maybe risk to the recovery that the ECB will have to act quickly because this is, will end up higher than expected?
I wouldn't say this is the biggest risk. We have to see that people, especially in Germany, are concerned also about inflation, about rising prices, not just concerned about possible restrictions or rising interest rates. I think the ECB needs to strike a balance between not being a burden on the recovery and at the same time reining in inflation. It's very important. I think yesterday's decision was very dovish. So the ECB says inflation will essentially disappear in 2022 or fall below 2%. That is very optimistic. I think it would be wiser to communicate clearly that this may go wrong and that the ECB may have to act earlier.
Thank you so much. The IFO Institute President there, Clemens Fuest, joining us this morning. Coming up, from supply chains to cybercrime, we look at the political risks for next year. This is Bloomberg. Here are your top stories today. Central bank divergence. While the Fed and the BOE see inflation as the main threat, Lagarde's ECB sticks to its pandemic-era monetary policy. Turning up the heat, the U.S. pushes EU allies for broader sanctions against Russia as the bloc fails to agree on a solution to its gas crisis. And the lira tumbles to a record low. The Turkish central bank cuts its key rate and says it's ending its easing cycle. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So first thing is first, let's always check on the markets, especially on a day like today, like we're seeing a little bit of pressure across the board. It's really some of the technology stocks that are leading the way down, but also some of the banks. Now, stocks overall are falling because of some of the policy that we heard yesterday. I guess today at the forefront, concerns about tightening monetary policy and economic risks from the fast-spreading Omicron virus variant is sapping a bit of sentiment. But we didn't have it yesterday, and nothing really has changed that much since yesterday. So it could also be a bit of profit taking. If you look at central banks globally, they do seem to be prioritizing this fight against the elevated inflation by tightening monetary policy whilst keeping an eye on the impact of Omicron. The other story we're watching very closely, another record low, and it's really quite incredible how fast it's touching that new low against the dollar, is the Turkish lira, marking an all-time new low at 16.1 per dollar. The other thing we're looking at is natural gas. Now, this goes to some of the politics that we've been following very closely. We, of course, look at natural gas, and that's a great chart, which we'll get onto Tina Fordman in just a second. Russian troops are still gathered near the Ukrainian border. The Biden administration is pushing its European Union allies to finalize a broad package of sanctions against Russian banks and energy companies should the Kremlin invade. With 40% of Europe's gas imported from Russia, the potential disruption of global energy markets could prove problematic.
It's of great importance to all of us here that Europe's borders are not moved, that everyone exists in security.
We maintain our call on Russia to de-escalate tensions and refrain from any further aggression. We would like to be in a situation where relations with Russia are good, but this is very much depending on the choices made by Moscow.
We had an important discussion with President Zelensky, and we have very clearly reaffirmed our attachment to the Normandy format, also together with Russia.
We have agreed that if there is a military aggression against Ukraine, consequences would be massive. We are disposed to coordinate concrete and operational measures together with all of our allies.
Now, from all of this, let's get straight to our European correspondent, Maria Tadeo, live for us in Brussels. So, Maria, Europe warning of massive consequences. What could those actually be?
Yes, Francine, massive consequences if Ukraine were to be invaded by Russia. That was the language that came out from this European summit that happened yesterday. We know that for 2 hours, European leaders were talking about the situation in Ukraine. Mr. Zelensky, of course, the Ukrainian prime minister, was also in Brussels 2 days ago debating the situation. Now, European leaders, as I said, agreed that there will be, quote, massive consequences for Russia, that the economic damage on the country would also be very significant, but of course will still don't know what that means in practice. Yesterday, the head of the European Commission said there is a list that could be put ready to work, but we still need to know what companies, what assets, and whether or not the people that would be hit would be very close to Vladimir Putin or not. That is something the United States, as you know, has been pushing very hard to have something on paper that would serve as a deterrent for Russia. The only thing I would also mention, Francine, is that yesterday we found out that the German regulator is probably not going to approve or certify the Nord Stream pipeline 2 until the second half of 2022. So that's a very clear signal that Olaf Scholz is not in a rush to approve this by any means.
Thank you so much, Maria Tadeo there, our European reporter joining us from Brussels. Now, the impact of COVID is, of course, going to be top of mind for most investors next year. According to Avonhurst Advisory Services, there's a wall of additional worries facing the world in 2022. These include tight supply chains, interest rate hikes and inflation, as well as trade and political tensions surrounding China. Other concerns include post-Brexit trade war between the UK and Europe and cybercrime. Now, joining us to discuss all of this is Tina Fordham, partner at the head of global political strategy at Avonhurst Advisory Services. Tina, thank you so much for joining us. Why don't we kick it off with Russia and actually some of the sanctions that we could see from there. Let me also bring you to a beautiful Bloomberg chart that looks at European natural gas prices plunging from a record close after Russia topped up fuel to region for the last time. There it is. Look at that. You can chart anything on the Bloomberg terminal. When you look at that, Tina, what does it mean for political risk going forward?
Well, what we've got is the most complex backdrop from an economic policy perspective than we've seen for some time, right? No investor today has dealt with rising inflation, rising interest rates, let alone the extra impact of COVID. And on top of that, if any of the geopolitical risks in our wall of worry were to manifest, we're talking about a much more volatile environment. Russia-Ukraine is just one, but I would say we should be thinking about whether Russia will invade Ukraine again.
What does that mean for actually how allies could respond? So I don't know whether at this point, so what, December 17th, 2021, we need to model and game theory if, some of these political risks that you outline in your 2022 wall of worries come up all at once. What does it mean for the world?
Well, it means, first of all, that policymakers' reaction function is much slower, right? I mean, I sometimes say kind of, flippantly, policymakers can do one thing at a time. And that thing is COVID. Central bank officials obviously dealing with rates, and these are what the factors markets are looking at most closely. What I think investors fail to appreciate about geopolitical risk is that this environment is actually a very opportune one for those actors willing to take advantage because of that slower reaction function. Biden has already said the U.S. won't militarily defend Ukraine.
Tina, this is what we have on your wall of worry. If we keep that up actually for a second, because it lays it out beautifully. You have inflation, which we talk on the show every day. Cybercrime, are we underestimating? We also talk about the China sanctions every day, but do we underestimate what impact cybercrime could have on the economy?
Well, cybercrime, among other effects, is a very useful way to continuously chip away at the defenses of great powers. But what's important about it, I suppose, is it's below the threshold of a military response, right? Any bank is being attacked every day. The governments of the United States and all European countries are being attacked every day, all the time. And this is part of a continuous sort of assault and a way of keeping big powers on the back foot and not prepared for other things. What worries me the most is that Iran, from the wall of worry, is getting close to nuclear capacity. Yeah. And both China and Russia have looked at how the West has handled COVID and said, these people are not going to be in business for long. And I think
which means what? That China could actually, for example, invade Taiwan and think that there's no consequences of this?
I think China is much more risk averse than Russia is. Maria talked about the deterrence factor of the current sanctions at play. China does not want to prompt anything requiring a military response, but China's also been very adept at changing the facts on the ground. And one of the things I always advise clients about is not to think in binary terms, invasion, peace. What about soft annexation, right? What about creating more disturbances? We've already seen more of that. And this kind of incremental posture can be disruptive.
But unless there's something ugly, the markets seem to ignore it.
That's right, because the markets too can only think about one or two things at a time, and that's interest rates and inflation and a bit of COVID. Even that's not registering, and that means that any geopolitical risk will be considered a surprise, even though it's definitely not.
One of the other things, I mean, if you look at, for example, China policy when it comes to the economy, are we underestimating or even misunderstanding the huge shifts that China would go through in the next couple of years?
Well, China is playing a long game and consolidating power as we go along. China is not likely to be more aggressive, but one of the things I'm tracking is how China and Russia might not perhaps coordinate as in lockstep, but hide behind each other in a way that we've seen, for example, at the United Nations, in order to accomplish what they really want, which is to change the rules of the game in global institutions to suit them.
Which is what? I mean, what
trade,
could actually come, right?
Yes, to change trade, to change the way the UN works and everything else so that they can, manipulate those institutions more to their advantage and impose more costs.
Tina, if you look at trade, I mean, supply chains have already moved quite significantly. So would this be China trying to, through political influence, trying to get them back?
Trying to get it back? Well, no, I think it's more to do with what China is doing in other places to control lithium supplies, making inroads in Africa and the Middle East with grain and soft commodities, and doing this all below the radar.
I mean, we also have a French election next year.
Yes.
How disruptive could that be?
Well, it's something that we all know how to watch. I think this is the 5th French election that I will have been tracking. We always see these headlines about the kind of, potentially most disruptive candidate, and that time it's Eric Zemmour. This time, rather, it is. It's very interesting to see the new candidate on the right. I think the base case has to be that Macron gets a second term. But what really matters about the French election is what it means for European cohesion and this so-called Franco-German axis in a world without Merkel. Although I would say, as an Italian, you will appreciate, let's keep an eye on what Mario Draghi does in terms of whether he goes for the presidency or stays on as prime minister, because I think Draghi is the European leader to watch in particular.
Yeah, we don't know how long he stays, of course, as in charge of the government. Thank you so much, Tina Fordman there, a partner and head of global political strategy at Avonhurst Advisory Services. Now, coming up, Barclays, Goldman Sachs, JP Morgan all plan to boost bonuses as banks seek to gain an edge in the deal boom. More on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, some of the biggest banks on both sides of the Atlantic are planning big payouts for their staff. Record results and intense competition for staff are driving the trend. Barclays, Deutsche Bank, Goldman Sachs and JP Morgan are all set to be considering boosting bonuses by up to 50%. As Omicron rages through many countries, many large financial firms are once again also allowing staff to work from home. Citadel, Blackstone and the Bank of Montreal are amongst them. Well, joining us now to talk about working from home and bonuses, Tom Metcalf, Bloomberg's European Banks editor. Tom, I'm quite excited to see these big numbers in bonuses because actually some of them really stagger belief, and it feels like every bank is trying to, updo each other to make sure that they have the best staff.
Yeah, there's definitely that sense out there. So earlier this week, you had Goldman and JP Morgan saying for its deal makers, you're looking at 40 to 50%. And then yesterday, Barclays were reporting that they're going to boost their whole bonus pool for the whole investment bank by more than a quarter, and that is pretty extraordinary. So clearly Barclays are looking to compete with the Wall Street's titans. And then a slightly different story at Deutsche Bank, where there's sort of a larger range, 10 to 20%, again, just for its deal makers. So that's a slightly different story there.
I mean, is this one of the first times where we're seeing actually European, UK bank trying to compete in terms of bonuses, where they're just the revenues are not as strong as JP Morgan or Goldman Sachs?
Yeah, exactly. And I think it shows to Barclays' ambitions in this space. They are clearly not moving away from this kind of transatlantic model, and they want to be sort of seen as on the same level as a Goldman or a JP Morgan. But yeah, it's pretty surprising to see a European lender, which typically is a bit more conservative.
Talk to me. I mean, first of all, does it get scrutinized by regulators? And it doesn't. It's not the same bonus as you're saying if you're a trader. Of course, if you're a junior or if you're an M&A this year.
Yeah, on the regulatory side, so last year the regulators were kind of putting quite a lot of pressure on saying, be careful with what you pay. So that's partly why you're seeing these big jumps this year, because they've kind of stepped back from that. Now the banks seem to be sort of capitally strong enough to pay what they wish. And then you have to remind me what your second question was.
The second question was simply if, you know, the revenues are a little bit different from one bank to the other. So does it actually, I mean, can they afford to pay this much?
Yeah, and I guess it's a real, that's the delicate balance in that, right? Like, it's kind of, can you keep your talent? Can you know, no one's ever going to be happy whatever the bonus is, but can you keep them largely on board? Because, you know, in this world, it's really that talent that drives that revenue. So it's, as long as you want to be a big player in this space, you kind of do have to pay up at the moment.
I mean, we're on to, what, the second year of the pandemic. I mean, there's this funny meme saying, you know, 2022 is a bit like 2022, which is getting people a little bit depressed. We talk about this great resignation. Have you seen a lot of bankers move around? And does that, you know, A, filter into the flexibility, so the work from home that bankers are giving their own staff? And two, is that why bonuses are up?
Yeah, we're definitely seeing people leave the industry. I mean, I think it's ever thus. You know, finance is notoriously hard charge, and you have to always work these hard hours. I think it's sped up both for the pandemic, but also these rival industries like tech, even fintech. That's sort of where some bankers are now starting to think, I can make as much money there, and it's a better quality of life.
So you had a lot of titans in finance saying, guys, you have to go back to the office. It's our culture, it's our DNA. Is there anyone that's left saying, no, you can't work from home?
I think right as of this moment, no one is going out there publicly saying, hey, we want everyone in the office, obviously. I mean, James Gorman at Morgan Stanley actually said, you know what, I was wrong to say we should all hurry back to the office. But I think realistically, you know, I think everyone's saying, let's see what Omicron brings. But if it goes back to what it was like a few months ago, I think you'll once again see a big push for folk to come back into the office.
Tom, thank you so much. Our Tom Metcalf there, Bloomberg's European Banks editor. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gearens. Hi, Leanne.
Hi, Francine. The Bank of Japan has kept its key rate and policy settings unchanged, citing a high degree of uncertainty from the pandemic. Officials opted to extend a COVID funding program for small and medium businesses until September. The BOJ says it will gradually reduce its holdings of corporate debt to pre-pandemic levels starting in April. Bloomberg has learned that the Bank of Montreal has expressed interest in buying the US business of BNP Paribas. Sources say BMO has held initial talks for the Bank of the West unit, which had a book value of about $14 billion as of the end of September. A wave of foreign lenders have been leaving US retail banking. And Airbus has handed Boeing another defeat, this time in a deal with Air France-KLM. The Franco-Dutch carrier has agreed to buy 100 A220 and A21neo aircraft from the plane maker. The order is worth more than $10 billion before typical industry discounts. This is just after Australia's Qantas also picked Airbus over Boeing for its fleet upgrade. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Coming up, humiliating defeat. The Tories lose a previously safe seat in a by-election. We'll look into what that means for the Prime Minister, Boris Johnson. That's coming up next. And this is Bloomberg.
Actually, the labour market is very tight at the moment, and companies around the country, when I talk to them, tell me this. This is the number one story. Talk about difficulties of recruitment. Secondly, there are, I have to say, signs of the inflationary pressures, which of course are difficult. You know, inflation at just over 5% is difficult. What we've been looking very closely at is how persistent it's likely to be, and there are signs now of more persistent price pressures, and that is a concern to us.
Bank of England Governor Andrew Bailey there speaking after this week's interest rate rise. Now, staying with the UK, and the Prime Minister, Boris Johnson, has been dealt a serious blow with the loss of a safe Conservative seat in a by-election in the West Midlands. Now, the Tories lost a seat they've held since 1832 with the Liberal Democrats winning by almost 6,000 votes. For more, we're joined by Bloomberg's managing editor for European politics. She is Flavia Kraus-Jackson. Flavia, good morning. Thank you so much for joining us. This feels very significant. How bad could it get for Boris Johnson?
Yeah, I mean, I think as we like to say it here in England, it was a proper kicking, and I think that's the way to interpret this. The Tory party was sending, and the electorate, of course, was sending in the same week very, very strong signals that Johnson is just not doing a good job. First, there was the revolt of 100 MPs, which essentially annihilates his 80-seat majority, and now with the electorate. So it's definitely a cause for concern. Now, as to the question of whether this is the beginning of the end, it's a question that everyone is asking. I think one has to sort of remind everyone that the Tory party can be ruthless, and when they feel that their guy is no longer a winner, then they can get rid of him. So the critical element to this is, how many letters are going to start coming in, and that would be the first sign that he's in trouble. Our sense is that we're not quite there yet, that Christmas will provide a little bit of respite for him to sort, in a way, kind of like pick himself off the ground and try and turn it around. Of course, if Omicron suddenly just keeps spreading at the rate it has, it's just going to look even worse for him. So there you have it.
Is there anything that he can actually do to turn around? How did we get here?
I mean, it's someone reminded me that this is like the season finale of Succession or something. Like it all, Owen this was an incredibly safe seat, and it all started with Owen Paterson and how Johnson tried to protect him, right? So it was an incredibly self-inflicted wound. Then the Christmas parties, etc. So it's gone completely full circle. I think the key thing is that, as we saw with Theresa May, who was desperately weak, it took quite a while for the party to finally get rid of her. So I think the scenario that we're looking at is potentially 2022 late to see if Liz Truss and someone like Rishi Sunak can somehow get a bit of momentum and maybe mount a leadership challenge. But, in the meantime, he's going to have to do that thing that he does, make people laugh, make people feel good about themselves, stop inflicting self-inflicted wounds on the party and on the country.
All right, Flavia, thank you so much, as always. Flavia Kraus-Jackson there with the very latest on UK politics. Now, let's also check on the markets. A lot of the pressure coming in from some of the technology sector. This is after we had a major week for central banks across the world. We're also looking at the Turkish Central Bank, and we're looking at the Turkish lira, 16.52. That's the kind of weakness that we're seeing across the board. Not something that we would have imagined a couple of months ago, but certainly once it got through that psychological level of 14, then it's been in free fall ever since. Stocks extending declines amid a drop in global technology shares. Again, the concerns in the markets is tightening monetary policy, but also they worry about this economic risk from the fast-spreading Omicron virus variant, which is sapping sentiment. If you look at the backdrop, investors now questioning whether global stocks are due for a rougher patch after almost doubling from the pandemic lows. We'll have a look at that. We'll also look at what it means for some of the emerging markets. It's not only about Turkish lira, but we're seeing a movement also in the South African rand. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller in Berlin, Kailey Leinz in New York, and Anna Edwards in London. This is Bloomberg.
Inflation is running well above target, and growth is well above potential.
And there are signs now of more persistent price pressures.
It is very unlikely that we will raise interest rates in the year 2022.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Friday, December the 17th. Our top stories today. Ratcheting up the pressure on Russia. The U.S. is pushing the EU to prepare sanctions in case Vladimir Putin invades Ukraine. Turning up the heat on China. The Biden administration imposes sanctions on Beijing over its treatment of ethnic and religious minorities. Congress targets companies that use Chinese forced labor. And President Biden paints a bleak outlook for the unvaccinated. He warns they risk a winter of severe illness and death. Welcome to Bloomberg Surveillance Early Edition, everybody. From London, I'm Anna Edwards with Tom McKenzie and Caroline Hyde, in for Kailey Leinz and Matt Miller. Good morning, everybody. Tom, it seems that European equity markets reflecting the global nervousness we've seen recently, the twin threats of Omicron spreading and central bank policy becoming tighter.
And that divergent picture between the central banks, notably, of course, the ECB and the BOJ, arguably on one side, the Fed and the BOE on the other. We had red across the screen on the Asian session. Japan really weighing up the impacts as well of Omicron. They're trying to ramp up the booster shots there. And the BOJ essentially holding off on significant tightening as they try and wrestle with, yes, an inflationary picture that is very different to what the Japanese have expected and seen over the last few years, but also that threat of Omicron as well. The Nikkei is lower, closed lower. You saw some pressure, of course, on mainland stocks in China as well. Tech companies as well. Chinese tech companies continue to be hit and scrutinised. And then you have the property sector, a downgrade for Shumao, one of the big developers there, by Fitch, following on from Moody's. That is a story and a theme that continues. Let's switch focus and see how things played out on the US. It was technology as well, and the NASDAQ closing lower by more than 2%. Apple was a big loser yesterday, closing lower by more, so almost 4%. Semiconductors also under pressure. In terms of your US 10-year yield, the yield's edging up about 2 basis points. It's at 142. And the futures stateside pointing to further losses of a little over 0.1%. Caroline.
Yeah, let's get the mood music, what's happening in terms of Europe at the moment, Tom, because as you said, there was this, of course, risk aversion that sunk into the US equity market in terms of the NASDAQ technology. We follow it lower as we once again focus more on perhaps what will happen with central bank policy actually stifling off growth, and indeed what happens in terms of the Omicron virus. I look at a sea of red across Europe. The French indices off by some 0.6%. You're looking at the DAX in Germany off by 0.5%. UK, one little ray of green at the moment, just up 0.25%. But let's switch it on a gear. I want to look at some individual bits of data that we digested here in Europe, which some of it was relatively optimistic. Let's go half glass full to begin with, because I want to look at what happened in terms of UK retail sales. Let's have a look at industry groups, because at the moment we're seeing retail sector doing particularly well. Retailers on the higher side, as we saw that UK number come in stronger than anticipated. This for the month of November, but what then of December as we see those restrictions ramp up once again in the UK. On the second flip side, though, is the auto sector in the worst performers here in Europe. Auto sector, therefore, is why Germany's on the downside. Why is that? Because for November, we had a record low registration rate for new car sales here across the continent of Europe. The supply chain is front and centre. We're seeing a move into some of your havens today, Swiss franc being namely one of them if you're looking at FX picture here in Europe, Anna.
Yeah, Caroline, with the pressure on technology names and that bad news out of the auto sector, difficult for the German market certainly to make any headway, and it doesn't. Let's have a look at what is happening today, what is on our radar for today. There's two events to watch out for in the United States. A quarterly rebalance of the S&P 500 after market close, and triple witching as stock derivatives expire, potentially causing volatility, and index derivatives, of course. Ryanair bids farewell to the London Stock Exchange. That also is set to happen today. It's the company's last day of trading in the UK capital after blaming its departure on Brexit. It, of course, will be listed in Dublin. It is not Ryanair style to go quietly, so we'll see. And it is the Bank of Russia's rate decision at 5:30 a.m. New York time. Inflation continues to accelerate, adding to pressure for the central bank to keep tightening. 100 basis points last time around. Expectations for a similar-sized hike this time around. Now, European leaders have warned of massive consequences for Russia if it were to invade Ukraine. EU leaders spoke about rising tensions with Russia in press conferences following a summit in Brussels.
It's of great importance to all of us here that Europe's borders are not moved, that everyone exists in security.
We maintain our call on Russia to de-escalate tensions and refrain from any further aggression. We would like to be in a situation where relations with Russia are good, but this is very much depending on the choices made by Moscow.
We had an important discussion with President Zelensky, and we have very clearly reaffirmed our attachment to the Normandy format, also together with Russia.
We have agreed that if there is a military aggression against Ukraine, consequences would be massive. We are disposed to coordinate concrete and operational measures together with all of our allies.
Let's get more with Bloomberg's Maria Tadeo, who's standing by for us in Brussels. Maria, good morning. So Europe now warning of massive consequences, some tough language, but what will that entail in detail?
Yes, Anna, and we heard it right there, that language yesterday. There will be massive consequences if Russia were to invade Ukraine, and the economic repercussions of this would be immediate. Now, we know that for a while the United States have been pushing on European allies to come up with a concrete list of companies, sectors, and people that would be targeted if there was some type of military intervention in Ukraine. The European Commission yesterday did not give specific information, but they did say we have a list that would be ready to go. We also know that for more than 2 hours, European leaders spoke behind closed doors here in Brussels. There were no phones allowed in that room. That happened when it's a very delicate, very sensitive situation, but also they don't want any hacking or any leaks. So it does show that this is very much top of the agenda. I would say, yes, we didn't get a lot of specifics, but that language that we played there, immediate repercussions, massive repercussions, that is a huge change in tone from the European Union, which you remember just a few months ago still said that there was space for dialogue directly with Vladimir Putin.
Maria, we've seen a drop in gas prices today, Russia increasing the supply to the European market. This is a topic that was discussed as well by European leaders. Do they come to any conclusions, any agreement on this issue?
Well, look, it's a number of things. On the one hand, we know that Vladimir Putin has kept the supply very tight this winter, but we also know that he's always very careful not to be in breach of contract through Gazprom. That's something that the European Union has always been very clear that Russia needs to honor the contracts. And secondly, of course, we know there was a big debate yesterday that energy prices, this is top of the agenda for many European governments. We're seeing prices pretty much skyrocket every day, and this is going to be a very expensive winter for many citizens across the European Union. But there was no agreement, and one of the sticking points, and this is really the issue now, is what to do with nuclear energy. The European Union was looking to transition away from that, but they're now seeing that this green transition, moving away from brown to green, is very expensive. You need a method that can transit from one to the other, and the question is whether or not nuclear energy will do the trick. There is no consensus around that.
Meanwhile, of course, we see gas prices in Europe slump today on the fact that Russia decided to turn on the taps to a certain extent. Maria, today, always great to have your updates. We thank you on the political side of Europe. Let's turn to the political side of the US. Over in Washington, well, Bloomberg's learned that the US is pushing the EU to finalize a package of sanctions against Russian banks and indeed their energy companies. That would be imposed if the Kremlin does indeed attack Ukraine. Emily Wilkins, Bloomberg government reporter, joins us from DC. Emily, the latest here, because once again, foreign policy front and center.
So at this point, we are hearing that the U.S. is trying to pressure their allies in the EU to really finalize this package of sanctions and have it ready to go. That way, the threat looks more credible when they come to Russia and say, hey, this is the price you're going to pay should you invade Ukraine. Now, not everyone is on board with that. There are still individuals in the EU who think that there needs to be time and space for diplomatic efforts to be reached. But President Biden, I mean, he understands sort of the threat that's being posed by Putin. He wants to make sure that he's responding in an aggressive way. You saw him really talk about this issue a lot last week, have that virtual summit with Putin. You know, this is going to be a bit of a test for President Biden. When he came into office, he said that part of regaining the U.S.'s foothold as a leader in the world would be working with their allies, and certainly the ability to work with the European Union on issues related to Russia. This is going to be a test of how well he's able to do that.
Emily, let's pivot from Russia to China. And I see that the Senate cleared a bill that it seeks to punish China for alleged oppression of the Uyghur Muslims. What is the detail here? What do we look ahead to?
So the legislation, it's cleared the House, it's cleared the Senate. All it needs right now is President Biden's signature. It would basically put an import ban on products from the Xinjiang province over concerns that they are being made with forced labor. Now, if companies in the area could prove that they were not making products with forced labor, they could potentially get a waiver to import their products to the U.S. But this is meant to send a very strong message to China that the U.S. is very concerned about allegations of human rights abuses, particularly with the Uyghur population. In addition to that, you saw various agencies take steps yesterday to add Chinese companies to various lists, either banning American companies from working with them or banning U.S. investors from investing in them. And this is really continuing a pattern we've seen throughout the Biden administration and a pattern that we saw in the Trump administration as well.
Yeah, United Nations saying that up to 1 million people have been held in those camps in Xinjiang. in China. China, of course, saying that these are just educational programs. Emily Wilkins of Bloomberg Government in Washington, thank you for the update there. President Biden is warning unvaccinated Americans that they face what he calls a winter of severe illness and death. The president urged initial doses and booster shots in the midst of a surge of coronavirus cases.
It's here now, and it's spreading, and it's going to increase. For unvaccinated, we are looking at a winter of severe illness and death for unvaccinated.
Sam Fazeli, Bloomberg Intelligence Senior Pharmaceutical Analyst, joins us now for more. Someone really who's been doing the deep dive on this subject from day one. Sam, always great to get your insights. Where do we stand then in terms of Omicron, the effectiveness of boosters, and just how severe this variant is in terms of hospitalization rates in the US and elsewhere?
Yeah, hi. Obviously, in the US, we really have no idea yet. I think the best data is coming out of South Africa, which, as I've said before, we have to take with a pinch of salt in terms of trying to extrapolate to other countries because of the demographics of the country, etc., and number of infections. But the data, coming out of South Africa seems quite positive. We've just heard that number of hospitalizations are down by 91% in this current wave compared to the previous wave, which is great news if it's going to be the same as what's found in other regions. And I do worry about the United States.
Right, so this is, good morning, Sam. This is good news from South Africa this morning. Certainly nice to have some good news on Omicron. But you've been very careful to point out to us a number of times before about how we can't just translate the South African experience into other geographies. Remind us of the backstory there.
Yeah, so in South Africa, depending on which province you look at, 70 to 80% of people have been previously infected. When I look at the numbers that we have here for other countries, United States sitting at 15%, Germany at 8%. How much immunity does prior infection give you? We don't know, but it will give you some. And then you've got vaccination rates, which of course South Africa's unfortunately not as far ahead as some of the other countries. But again, you look at the United States, they're at 61%. Compared to, say, 79% in France and 88% in Portugal for 2 doses. So all of that combined together suggests that if immunity, which is, I believe, the case, a significant driver of the severity of the disease that you get with these upcoming, this variant and other variants, then we have a problem in the rest of Europe. And that's why we can't translate the data from South Africa directly to other countries.
OK, really interesting insights coming through from South Africa. We'll continue to monitor those. Sam Fazeli, thank you very much from Bloomberg Intelligence, of course. So that is a look at where we are on the latest on the COVID battle. Let us get now to Caroline, who can give us a look ahead to the US session. Caroline?
Yeah, as we all continue to see that Omicron variant become the focus of whether you've got your party cancelled or not, we're going to focus in on some of the corporate earnings. And, well, one of the winners, of course, within all of the supply chain issues and indeed the rise up in freight costs, has been that of FedEx. They came out with their earnings after the bell. FedEx rising almost 5% in early hours trade. They did well after hours as well after that numbers hit. They're able to pass on their cost increase by raising their prices. Revenues rise, profit does well, the market moves higher. Let's look at Oracle, because it looks as though we're getting a little bit of M&A potentially. Oracle could sink a little bit pre-market. We could see, though, Cerner rise as we are being reported by Dow Jones that we could see this company make a bid up to the tune of some 30 billion valuation is thought for Cerner. Now, this, of course, is a medical records company. Oracle down by almost 3% in the pre-market. And I do this one for our Matt Miller, who we miss. You've got to keep it on the EVs. You've got to keep it on the autos. You've got to keep it on Rivian, who also came out with their first ever public earnings last night after the bell. And it didn't live up to expectations. Down almost 10% in early market. This is Rivian saying, look, we're not going to meet our overall production targets to the tune of a few hundred vehicles, Anna. Yeah, the biggest listing of the year last month. We remember it well. We'll watch that one at the open then, Caroline. Coming up on this programme, the fight against inflation. We'll discuss the latest in central bank policy. Freya Beamish joins us from TS Lombard. And tech stocks signalling more pain ahead after yesterday's decline. Nasdaq futures down 0.6%. More on the tech sector shortly. This is Bloomberg. Now, this week has been dominated by two key themes, Omicron and central bank policy, and the divergence in central bank policy. Great chart coming from the terminal today. And we give a shout out to Valerie on the back of this one, because we see really the Bank of England, of course, going in alone, hiking rates, taking the market by surprise, of course, yesterday. And therefore, in 2022, we're expecting, 3 rate hikes coming out overall? But Federal Reserve signaling its path to us of more hawkish tilt, but a sort of dovish hawkish tilt. We're expecting some 3 rate hikes into 2022. Therefore, mid-2022, the chart is showing about 1.5. But then, of course, the ECB, Madame Lagarde, saying, no, we're still seeing this inflation as transitory. No hikes in 2022. Interestingly, the market does not know what to make of this. In the US, the Treasury market, well, we saw the yields on the 2s and the 5s come down significantly yesterday. They don't buy, maybe, those Fed hikes to the same extent the 8 signaled by the Federal Reserve. What then of corporate credit amid all of this? If yields in sovereign debt are going to remain so low, is it time to get into corporate credit? Dana can be talking it through with us. Dana El-Baltaji, she's a Bloomberg managing editor for EMEA Credit. And you've been looking at the high yield response in particular and some of the key parts of the market. What did it make of, for example, the Federal Reserve's dovish hawkishness?
Well, this was really interesting, actually, especially for junk debt out there, because on the one hand, we had this beautiful anchor for the last almost 2 years, really, where junk debt has managed to really thrive. And yet now we're seeing that slightly lifted, and we are seeing the threat of it lifting even more. But they were comforted by the fact that the central bankers, not just in the Fed, but here too, are very concerned about growth, and they don't want to hurt economic growth. And where there is economic growth, that's great for junk's debt.
Dana, let's pivot to what's going on in certain emerging markets, and I'm interested in what's going on with the Turkish lira, a clearly very volatile currency these days. I mean, moving another 7%, weakening another 7% today. The focus has always been on the slightly unconventional central bank policy here. We saw more of that yesterday, but we were told that actually the rate cutting cycle is likely over. That's what the central bank said, but it doesn't seem to have put a floor under the currency.
No, absolutely not, because after the decision, the government basically went and raised the minimum wage by about 50%, which will be implemented next year. Now, the thing is with that is that will add more inflation in Turkey, which is the last thing that the nation needs. So when you have a currency that's tanking and you've got inflation that's going through the roof, what you don't need is to take away one of the things that would make the nation actually attractive to foreigners, which is the relatively low cost of labor. So, I mean, it's very hard to know where the currency is headed, but what we do know is that certainly that those corporates that do have foreign debts may find some issue with refinancing next year.
Dana, I want to fold 2 into 1 here. The idiosyncrasies of the monetary policy response in Turkey, can that keep it contained to Turkey, or is there a bleed across to EM? And what does 3 hikes from the Fed, the dot plots, of course, that's the forecast, what would that mean for EMFX leading into 2022?
All right, so first with Turkey, I think because the circumstances there are so specific to Turkey, I think right now a lot of people kind of accept the fact that it will be contained within Turkey. With regards to the impact of these rate increases in EM, I mean, what we're seeing is, for instance, Russia and other emerging markets are raising rates, and they're trying to be ahead of the curve so that then they maintain the integrity of their own currencies. They will have to be dealing with a stronger dollar, and that's why they are trying to be more proactive.
OK, another 7% move on the Turkish lira then against the dollar today. Dana, thank you very much. Dana El-Baltaji joining us there from the Markets Live team. And remember, you can get market analysis. Check out MLIV Go on your terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Caroline Hyde with Anna Edwards and Tom McKenzie in London. Now let's get the first word news. In the UK, it was a pretty humiliating political defeat for Prime Minister Boris Johnson. His ruling Conservative Party lost a key parliamentary election to the Liberal Democrats. It was a seat the party had held since it was created in 1832.
Goldman Sachs says it can't rule out oil at $100 a barrel. That's in 2023. That's because supply additions are expected to be too slow to keep up with demand. Goldman's base forecast is still for Brent to stay around $85 the next 2 years. The bank says that consumption of gasoline, diesel and plastics is expected to reach new highs. And in fact, Corvalin, who is writing this particular prediction, thinks that oil prices could go as high as 110 unless we get some demand destruction.
And so you have to look through, obviously, the immediate impacts of the reductions in travel and people cancelling trips, because, of course, that's going to be a drag on oil. In the near term, you're seeing losses of, close to 2% across Brent and WTI, but longer term, that projection of
absolutely. They focus on insufficient supply in the face of that strong demand. There's a lot of uncertainties around both of those, the supply and the demand side. We'll watch the oil story for you. Coming up, Freya Beamish, TS Lombard, Head of Macro Research, joins us. This is Bloomberg. This is Bloomberg Surveillance Early Edition. From London, I'm Anna Edwards with Caroline Hyde and Tom McKenzie, in for Kailey Leinz and Matt Miller this morning. European equity markets, Tom, very much on the back foot. The twin concerns then around the Omicron variant and, of course, policy tightening globally, not just the sort of hawkish pivot from Jerome Powell and the Fed, but elsewhere. We've seen this picking up momentum.
We have indeed. Certainly the emerging markets are making sure, as we were discussing earlier, that they don't want to be caught out by the 3 hikes that are now penciled in by the Fed and the pressure that could put on their capital accounts and outflows. So they've been hiking rates. And in terms of the divergence as well, that's split arguably between the ECB BOG versus the BOE, which of course hiked yesterday, and the Fed that's laid out its time frame in terms of the taper and those dot plots. Yeah, inflation a concern in Russia as well, waiting for a Russian rate decision. There we go, the rate hike possible at one of the next meetings, so says the Bank of Russia. So we will follow these headlines as they come through. The expectation had been that we would get a 100 basis points rate hike this morning, so we'll continue to focus on that. There we go, there's the red headlines. They're raising their key rate to 8.5%. That was the estimate. So this is in line with expectations, raising their key rate in Russia. It's a growing theme, Caroline, rate hikes.
It is hawkish sentiment, unless you're the ECB, of course, which says, look, not getting any rate hikes until 2022, although we did know that Madame Lagarde is just trying to pull away a little bit at that stimulus. I'm looking, therefore, in the reaction to the ECB yesterday, and mainly in the reaction to what happened in the United States yesterday. The Stock 600 is currently off by 0.75%. We've got a bit more of risk aversion in the market today. The S&P 500 futures also down by 0.3%, but the Nasdaq is also where you want to be looking. Many questioning how much these growth stocks can weather the increase in interest rates. Of course, we saw a significant fall in the Nasdaq, down by almost 2% yesterday. Money moves out of the US 10-year. We've got a little bit more flattening in that yield curve, though. The bond market is signaling they do not anticipate the growth that the Federal Reserve does. And can we really see those 8 rate hikes if they go this fast? And to begin with, Bitcoin, I do this to Matt Miller, off by 2.5%. I'm afraid it's a risk asset for now. It is not an inflation hedge. 46,879 is where we trade. Flip it on a gear and let's look at the individual pre-market movers. FedEx up almost 5%. Their earnings coming in strong, helped by the fact that they raised their prices. Freight costs went up. They passed that on. Sales do well, up more than double digits. Cerner gets a bid, we understand, potentially from Oracle. There are the reports up or more than 15%. Rivian down as their earnings miss expectations in terms of production. And Tesla, well, Elon Musk, he keeps on selling out of those shares. Tom, what are you watching this morning? Well, of course, technology and the sell-off on the Nasdaq yesterday was pretty pronounced, wasn't it? And you saw the read across to the European session as well. We've got a chart, though, that shows what's happening in terms of that open interest, the aggregate open interest for technology, the Nasdaq 100 versus the S&P, and it is still there. You can see this almost crocodile mouth-shaped chart here towards the right-hand side, that demand, that interest in technology, despite the fact that we have dot plots signaling 3 rate hikes. The question has always been, to what extent can technology weather higher rates? But if you have a terminal rate of 2.5%, and that's what's being flagged at the moment, maybe the technology sector can weather that. Maybe it's also a question of distinguishing between some of the frothier parts of the sector and those big-name tech companies that have the balance sheets to weather what is ahead of us. Let's get more analysis now on the call from Freya Beamish, TS Lombard, Head of Macro Research. Freya, thank you for joining us this Friday. What is your take in what is happening within the technology space, within that growth space? Is it a question, then, of having to distinguish, again, between those with the balance sheets and the ability to weather inflation versus the frothier parts, the SPACs and the non-profit-making parts of tech?
Yeah, I think to an extent these things are seen as trading light duration. We're not entirely convinced that that is how they should be played. But kind of in terms of how the Fed is actually going to behave and how these sectors are going to be affected, we think that there's the potential for divergence at both the beginning of the year and the end of the year in terms of where market implied probabilities of Fed hikes actually sit. And the beginning of the year is certainly dominated by this rise in inflation anxiety, this kind of global pivot among developed market central banks, obviously not the Bank of Japan, but more broadly, a rise in concerns that inflation is going to stay high. And for the Fed, that is really about the labor market. So we think that the first hike could even come forward to March, and this anxiety is just going to continue rising through most of the first half. But as I said, at both ends of the year, we're actually seeing some divergence from what's out there in terms of market implied probabilities. And in the second half of the year, what we see is this sharp bullwhip down effect in inflation of goods prices, which has been the main driver so far. And that's going to take off a lot of pressure on central banks and answer some of the questions, cutting off a lot of the threats between the potential for wage price spirals to come through, and allowing the Fed and other developed market central banks to just go a little bit more slowly.
What is the resilience of corporate balance sheets then, when you take into account all of those factors?
I mean, I think that it's the Fed is going faster because they recognize that the economy is stronger. So it's a kind of a twofold driver here. First is that they're worried about inflation being more sticky than they thought. They're worried about these spirals. We're not so worried about that. But also because they see the recovery as moving forward faster, and that's a function of strong earnings growth as well, and that should help out corporates as well.
You talk about, so good morning to you, Freya. You talk about how the second half of the year, we're going to see less pressure on central banks because, of course, of the comparatives for inflation with the year before, and that makes a lot of sense. I suppose a lot might depend, though, on what kind of supply chain disruptions we continue to see from China. And with China not having experienced very much of the COVID wave, very effectively keeping it at bay in the early days and on an ongoing basis, does that present tougher risks ahead, actually, for the global economy because of the way they will shut down ports if they need to?
Yeah, I think it's almost China's role in the global economy could help out initially, and then people could start to focus more on the growth aspects of it. So it's partly starting where you started. It's partly a function of base effects. I think markets do tend to underestimate that. You'd think it would be something that would get priced in, but in Q2 the drag from base effects will be very, very strong. But it's much more than just those base effects. So the analysis that we've done on the supply side suggests that there has been this very strong bifurcation of the capex story and the labor market story, so that parts of the supply side are now much more adapted to accommodate the positive demand shocks that you get through high periods of COVID. And that means that the inflationary shock that you receive as a result of potentially things like Omicron, new variants coming forward, is going to be much less in 2022 than it was in 2020 and 21. So you get a kind of a downtrend in inflation resulting from the previous shocks and the supply build out there, less demand coming through as well, because of a lot of the demand in the first round was simply people building for a world that simply didn't exist before COVID. And that demand is non-repeat at the same time as we have this build out in the supply side, particularly for the PPE equipment, if you look at the Chinese data as well. So a downtrend in inflation, yes, shocks derived from Omicron, but I would say the inflationary side of those shocks is going to be much less than we've seen historically. And then in terms of China's role in that, sorry, go ahead.
Yeah, Fred, I'm just interested in the fact that on both the US side and indeed it seems worldwide, you're feeling the inflationary pressures aren't going to be so seismic as the market had been worrying about. Already we see in the bond market in the US, they're starting to think the Federal Reserve is not going to be hiking as much as they're currently signaling because inflation will come down. Do you rate, therefore, like, mark them out for us? Is the ECB on the right track? I mean, they're still calling it transitory.
So I would move on from the transitory, because it's been too long, and it's for one thing, it belittles what people are actually feeling, but for another thing, we can do better than transitory. Transitory is very kind of vague. So what we're doing now is to define a new framework that's specifically designed for the presence of an endemic virus. We're calling it bifurcation inflation or biflation. And there's a few results to that. One is this kind of bullwhip down effect that you see in the second half of next year. So before then, maybe the inflation anxiety continues to build, but there is a little bit of a kind of a debate going on in markets at the moment as to whether the Fed now kind of has that under control. They're ready to kind of move faster, and it's the old adage that, you know, once they start to move, do they actually need to follow through that with what they're promising? And in this case, what is driving that is the strength of the dollar. The part of the Fed forecast that has been off is the import price inflation, and if that starts to come down, then the Fed forecast look a lot more palatable. So that certainly augurs for markets moving away from this kind of hawkish tilt, but really only, I think, as we move through 2022, I think the anxiety before then can continue to build.
OK, so bifurcation inflation is what we're heading for in the second half of the year. Freya, thank you very much. Freya Beamish, TS Lombard, Head of Macro Research. Coming up, tech unravels with the Nasdaq 100 sinking the most since September, down in yesterday's session considerably. More weakness lies ahead, according to Nasdaq futures. More ahead. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, Vertical Aerospace CEO Stephen Fitzpatrick. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Caroline Hyde with Anna Edwards and Tom McKenzie, and we're all in London. Meanwhile, let's have a look at technology companies across the pond diving in terms of, well, the speculation that rate hikes will reduce the appeal of the industry. The Nasdaq 100 is sinking the most since September. Let's try and get underneath the skin of what's going on in the markets, because it's a deeply confusing place to be right now. Christina Aquino is with us, because on one side, I'm looking at 2- and 5-year yields falling yesterday because apparently the market no longer believes the Federal Reserve can hike as much as it had signaled. But then the Nasdaq and some of these growth stocks really taking a tumble because we're worried about interest rate hikes. Is it just the immediacy of them, Christine?
Well, Caroline, I think there's a few things going on, right? Because I'm with you in the camp of confusion in the aftermath of the Fed and the reaction in tech stocks, which was positive initially. But I think what really shifted the narrative for markets is the fact that what we saw yesterday was it wasn't just the Fed that's worried about inflation. We also have the BOE worried about it, and to some extent the ECB as well. And so what you have is really a bit of a collection of the world's biggest central banks, right? Shifting towards this hawkish sort of policy and really driving home the message that the concept of transitory inflation is perhaps past us now, as Freya Beamish was saying earlier. And so I think this narrative that we've really moved on for the concept of transitory inflation, we're heading into 2022 with a concerted tilt towards hawkish policy, all that is probably weighing on tech stocks more than it initially did in the aftermath of the Fed meeting.
Yeah, Freya telling us we're moving on to a world of bifurcation inflation, something for me to dig into later. Christine, it's not just central banks in the G7 that have been talking about inflation, of course. It's also emerging markets. We've seen rate hikes there already. And Russia springs to mind today because we got a 100 basis point hike from the central bank in Russia. But that was expected because they've done it before and perhaps they'll do it again.
Absolutely, Anna. And I think the initial indication from the Bank of Russia is that we could see another possible rate hike in one of its next meetings. And so this is very much an indication, as it had been throughout this year, from the Central Bank of Russia, really wanting to signal to markets that it's doing its best to get ahead of inflationary pressures. It's no doubt that this is very much the reason why the ruble, for instance, is one of the only 3 major emerging market currencies that have held on to gains versus the US dollar this year. And investors have really responded to the series of rate hikes that we've seen from Russia. It's probably one of the most credible central banks as perceived by investors in terms of fighting inflation. It's going to be interesting, though, how that compares with the rest of the developed market complex now that we're seeing this tilt towards more hawkish policy as well, and whether those gains can be sustained in 2022.
Christine, yellow metal gold getting a bit of a bid today, above $1,800 an ounce. Does that continue that support after a pretty bad year for gold, down 4 to 5% year to date? Can it sustain some gains into 2022?
Well, no, I'm no gold expert, but I can tell you, obviously, this probably relates as well to the broader picture, particularly as it pertains to the dollar, right? And I think it really depends on, again, like how this whole growth versus inflation picture shapes out, because gold is obviously a popular inflation hedge. And so if we're in an environment where people are definitely getting a sense that inflation is really starting to become entrenched, then there's the potential for gold to capitalize on that. But then at the same time, if the dollar starts responding more to the possibility of more Fed rate hikes and faster Fed rate hikes next year, then that could be a bit of a headwind for gold. So I think what we're probably going to see is a bit more two-way risk, given that we have all these factors that are coming into fore next year.
OK, the opportunity costs involved with gold. Christine, thank you very much. Bloomberg's Christine Aquino joining us from the Markets Live team. This is Bloomberg.
Welcome back. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie alongside Anna Edwards and Caroline Hyde in London. The UK has the EU to thank for sending enough vaccines to fight its COVID situation. That is according to the EU's internal market chief. He sat down with Bloomberg's Maria Tadeo.
We have the quote-unquote ammunitions, including with the new booster that we will adapt now for the variant. But of course, now we need to rush.
And how many million doses do you see when? You know, I know you're working specifically with mRNA. This is Moderna, Pfizer. Yeah. You're not working with AstraZeneca. Many reasons for that. But when do you see the deliveries for those booster shots?
Well, we just ordered a new 180 million doses now. With
180 million.
180 million now with the new, let's say, vaccine to be adapted to the variant. But of course, we know that what is extremely important, because in fact, I think everyone should understand that we have 2 pandemics. In fact, we have still coping with the Delta variant, and which is the vast majority here in continental Europe. So we need to get vaccinated, and we have more than enough, of course. And now, of course, to be prepared for the new one, the Omicron, and we will be ready. But also, I think it's important to know that we are the first, from far, exporter of vaccine worldwide. Above China, above the US, above everyone. We will continue to export to everyone, including for our British friends, which are depending so much from us and are in a so terrible situation.
And of course, that is a message that Europe always likes to remind the UK that we are exporting vaccines there. You say they're in a terrible situation. When you look at what is happening, it's terrible. You say, when you look at what's happening in the UK, does that scare you? Does it worry you? Or actually, do you feel ultimately the same is going to happen here? Is it specific, to the UK?
Again, we have to be very cautious. What is important is that, of course, the UK is so depending from Europe for so many things, including for the vaccines. But I want to be today to say to our British friends, don't worry, we will continue to deliver what you need.
And the message that you're passing on is clear. I wonder what the reaction would be in London.
No, the message is that in Europe we handle this together.
Bloomberg's Maria Tadeo talking to the EU's Thierry Breton with a fairly typical cross-channel, multi-layered message for the UK. Right, Tom Keene, co-anchor of Bloomberg Surveillance, joins us now. Tom, it's Friday. What is on your mind?
Friday's on my mind. This is an important Friday every year in America, but it is different this year. This is actually round about the Friday of December 15th, the real beginning of the holiday season. We saw yesterday, I believe, Goldman Sachs canceling their parties. We all know about the real challenges in America. I would suggest the greater challenges in Europe. What does it mean for travel, and what does it mean for these nations? How about a chart on Italy? It's not across the channel. Maybe Thierry Breton is not looking at this, but it's the summer peaks. This is when Brad goes to Venice. My friend Brad is very good about going to Venice 2 or 3 times a year, peaking out with the cruise ships in the summer. Down we go with the pandemic, and we come back, but not so much. And Anna, you know, this is the tension that Italy and other nations face on tourism and the new bout of this horrific pandemic.
OK, a focus there, of course, on the travel disruptions across Europe as a result of Omicron, the restrictions that some governments are putting in place. Tom Keene, of course, back with Bloomberg Surveillance just shortly. And now look at what else we're watching. We have a scoop by Bloomberg, in fact, on Huawei and reporting that suggests that, in fact, there is now evidence. And this has long been claimed by Huawei. There's no evidence. Now Bloomberg's reporting suggesting that from 2012, there was an Australian breach of a telecoms company, Huawei. Engineers were compromised by Chinese intelligence services, and they installed software. It allowed them to hack and record, and then that software self-destructed. So it just builds on the case for Huawei, which still remains, of course, a major supplier of this hardware equipment at a time and during a week when the Biden administration has hit China with additional curbs and is looking to roll out additional curbs on its tech sector.
Yeah. You're looking to Asia. I'm going to look to the US, and actually a deeply Silicon Valley story that's become a worldwide one because, of course, we all know the story of Theranos, the blood testing company worth $9 billion, but then plagued into, well, accusations that she committed fraud. This, of course, being Elizabeth Holmes, the founder of Theranos. She's currently fighting in court, and the jury is going to begin deliberating later today, we understand, as the defense team closes the arguments today on Theranos founder, whether or not she did indeed build a business and not a criminal enterprise. We'll watch to see how that unfolds.
We'll certainly be watching the courtroom drama there. We'll also be watching the markets, though, I know, Caroline and Tom, because it is triple witching today, which, deserves a cheer. I'm never
you know
sure
what we
why.
need? Volatility. That's exactly what we need
exactly
right
what we haven't seen enough of that recently. So it is typically a very volatile period, a very volatile trading day of the year, of course. And, of course, coming just so close to the holiday, so close to the break, it can be even more volatile. The S&P 500 index has closed lower for 7 consecutive triple witching days. And reminder, just of course, if everyone needs it, that this means stock options, and index futures, they're expiring. And so that is why we focus on volatility for this particular event. A lot of people, it's suggested by some that we've been talking to here at Bloomberg, might use this liquidity to reposition if they want to around what we heard from the Fed this week, which would be an interesting development. And what was deemed, hawkish, dovish?
Dovish hawkish.
Dovish hawkish.
Which way round, Tom, should you say it?
Does it matter which?
Let's go with dovish hawkish.
I'm not sure it matters which way you put them if you're going to use them both. But anyway, there was something in it for everybody. Maybe we take that message away. Now, more Bloomberg surveillance is ahead. We'll hear from Claudia Sam of the Jane Family Institute and David Riley of Blue Bay Asset Management. No doubt he'll have a lot to say about sterling. 2 months in a row, the Bank of England catching the markets off guard. The central bank governor of the BOE says it's not up to him to guide the markets. I wonder what David Riley thinks. More on the markets next. This is Bloomberg.